Welcome to Deal Flow, the show that explores the world of investment banking, corporate takeovers and private equity deals. I'm Erika van der Merwe. We're looking tonight at the fluidity of deal making and economic activity across Africa. Are deal makers with pan-African ambitions being held back by increased regulatory layers, by multiple currencies and by trade barriers, all of which could sour the sweet potential of this high-growth market? Our guest tonight to talk about that, Tapiwa Shamu. He's a principal for corporate finance at Nedbank Capital. Pieter Steyn, director at Werksmans attorneys, and joining us from London, John Foster, Africa correspondent at Debtwire, CEEMEA. Welcome, gentlemen. Good to have you here. Tapiwa, let me start with you. So when one reads about the African region and regionalization, immediately what pops up is all the trade blocs. I believe there are 8 trade blocs across Africa and plenty of ambitions to have a free trade area, a large common market. Is this objective, would this be supportive of economic growth in your opinion?
Yes, Erika, absolutely. As we were discussing before the show started, effectively what happens is as you get greater trade blocs, lower barriers for companies to trade within other countries, it increases the markets they can play in, and with that comes effectively scale. Effectively the ability to trade for much larger numbers and therefore increase your ability to attract larger numbers of consumers, larger numbers of customers, and generally increase your GDP within the region in general.
Yes, Pieter, that's the point, isn't it? We keep hearing about Africa, 1 billion consumers, this huge market, but this huge market is fragmented. So at this stage, one is dealing with these pinpoints within the continent.
Absolutely. I mean, one talks of Africa as if it's one unit, but actually it's 54 different sovereign states. I think the trade blocs are a very exciting and important development, but there are key challenges, and one is the political will. I mean, the talk of a free trade area, a common external tariff, raises all sorts of issues for nation states. For example, I know in debate in Zimbabwe at the moment about the COMESA customs union is that they're going to have to reduce their tariffs. That means lower revenue for the government plus a possibility of greater imports. So there are lots of issues to take into account, but I think the key thing is political will, and that the benefits of free trade outweigh the possible disadvantages in the short term.
We're bringing in John Foster from London. John, so a number of perhaps conflicting objectives here, with the greater good being better growth for the region and also better deals, generally speaking. From your perspective, tracking deal, debt activity, trade finance activity, is there indeed fragmentation that at this stage is holding back growth and performance?
Well, I mean, there is a lot of fragmentation between the different regions of Africa, and I agree with sort of Pieter, how I was earlier, saying that in the utopian sort of world, it would be wonderful to have, one trading area, one currency, no tariffs. But unfortunately, in the real world, there's a lot of sort of political hurdles to that process. And going towards a place where there's greater currency integration. A lowering of sort of tariffs means that a lot of the economies in Africa have to sort of be on the same racetrack, never mind sort of, same racetrack, never mind in the same sort of, area. So I think in many ways the political side has got to be sort of looked over, but in the utopian way and in the growth of sort of trade within Africa, between African nations and also externally, the growth of these trade blocs is very important.
So we're talking about sort of sovereign states dealing with each other, economies trading with one another, but meanwhile corporates are already doing this. You've got corporates in say East Africa, increasingly you're seeing that, having a presence in Tanzania as well as Kenya and trading across that, in Ghana and Nigeria, for instance, in the West. So meanwhile, while the politicians are talking, the business people are doing it.
No, absolutely. And once again, I mean, if you're going to have greater regional integration, in my perspective, it's got to be bottom up. That's the right way it should happen. You've got to have increased trade between the countries, increased supply chains between the countries, because that is what should drive policy rather than the other way around. You can't have governments pressing down to the companies what they should be doing, otherwise it's never going to succeed. It's got to be a bottom-up approach. So it's absolutely right.
Pieter, the infrastructure, so you've got almost the institutional infrastructure, policy making, etc., but then also the physical infrastructure perhaps hampering some of this activity.
Absolutely. I think the key thing is these trade deals must make commercial sense, otherwise they won't work. And I think these infrastructure corridors, it's not just a transport corridor, it's a developmental corridor. And I think the Maputo-Gauteng corridor is a very good example of a developmental corridor which has been quite successful. I mean, there are good developments. For example, in the Zimbabwe-Zambian one-stop border post at Chirundu is an exciting development. Lower transport costs, quicker border controls, simple things like that. Not sexy things, but simple things to facilitate business, to help the businessmen do their business.
Indeed, if you talk to people doing business across the continent, top of the list, I'd say in the top 3 is how long their trucks wait at these various border posts and how that can absolutely eliminate their business potential, Tapiwa.
Absolutely. And in fact, in the example that was used just now, they managed to reduce the timelines for the trucks going across from as long as a week of them sitting there by the Chirundu border to actually a day. So this is obviously quite critical. There's no way that you can do business unless it's practical, and it doesn't cost you more to get trade across to that country than it does to get to another market or to your domestic market. Those infrastructure developments have to happen, and they have to happen on a regional level. Otherwise, it's just too expensive for people to trade with each other within the continent.
John, what are the nodes that you're seeing in the region? We've referred to East Africa, West Africa, South Africa, and often South Africa's economic dominance is cited as a potential obstacle to greater regional integration. So presumably many of the opportunities and the activities that you're seeing are concentrated in South Africa, but where else are the nodes?
Well, I mean, we do travel around the continent a lot, okay? We sort of visit East Africa a lot, we sort of visit West Africa, we've got sort of correspondents, across the whole continent. East Africa has been the most exciting place I've been this year, just because, as people were saying earlier, you were seeing people at the sort of very, very basic level. Kenyans who are trading in Addis Ababa, Kenyans who are sort of trading across in Tanzania and Uganda, in small scale, developing the economy, and that's where the economy is really, really going to build from. The point about sort of South Africa is again, you look at sort of the Eurozone, the problem with the economic and the sort of currency integration we have in the euro was that all the economies were not going at the same speed. And the problem you've got with the development of something like an Afro or sort of a common sort of market is that South Africa, obviously at the moment, is still the dominant market. And it's got a very, very diversified economy, whereas most of the other economies, even in sort of Southern Africa, are very, very sort of one-track exporters of sort of commodities, exporters of resources, and they don't sort of move in the same, with the same momentum or with the same sophistication that a place like South Africa does. However, that said, even within the trade blocs, there's a lot of red tape which can be addressed at a governmental level. So having to have 1,500, 1,600 documents just to take sort of potatoes from one country to another within a trade bloc is, not good for sort of trade. And so that has to be addressed as well, and getting rid of sort of the red tape and the non-sort of tariff barriers to trade are one of the things that I think can be done, on a regional level. But I think on the wider level, the sort of currency integration question, the common market question, is something that can't be approached right now because there isn't an integration either sort of political will or of infrastructure will. The biggest barrier to trade in Africa is its infrastructure. In the perfect utopian world, a man in Kenya who grows tomatoes